May Day was the parade in Moscow through all the, remember all those goose-stepping Russian soldiers with the tanks? So it's shocking to me. I guess May Day everywhere else in the world is like Labor Day. That's what it's considered to be. So like literally all of Europe is on holiday. I think quite a lot of Asia is on holiday too. China is on holiday. So, but in America, we are working hard here.
We certainly are. We appreciate you guys being here on May Day.
Labor Days for us here, but
that's right.
Yeah, it's always jarring to me that because I always associate May Day with like the parade in Moscow, not with it being a Labor Day everywhere else in the world. So, but it is, and so therefore the markets are a little quiet. But as Kathy was saying, quiet today. They're going to be loud this week. There's a lot of event risk on the calendar.
Yeah, let's jump right in. What do we got?
Yeah, we've got a very, very busy calendar. And as Boris said, we're kicking off with a quiet start to the week. And, May is always a unique month in the markets. It's the month before the summer holidays, is the month where, many investors are wondering whether they should sell in May and go away. It's the month where some central banks, they have rate decisions and then they sort of, have kind of,
go to the beach.
What I'm trying to say is that they had their major rate decision, and then all the other ones, they tend to not make big moves until September. So this is a very, very important month in the market, and this week in particular. Actually, before I continue, for those of you that are on the Twitter stream, I'm going to add our YouTube stream that you can watch our charts, as well as see Boris and I and Corey speaking to you. It's a better place to be looking at everything. So please tap into the YouTube link once it comes up. It's for some reason my tweet is still sending. Anyway, May is a really big month, and this week in particular is a very busy week. We've got 3 central bank rate decisions. We have non-farm payrolls. We have the Canadian jobs report. We have inflation data. And so this week, I think, could set the stage for how the markets trade in the weeks and months to come. And in many ways, it could determine whether or not we get the sell in May and go away kind of dynamic for the markets this year. Now, it's a really interesting, and later on, I could share some statistics. It's a really interesting concept, sell in May and go away, because historically it's it's not necessarily true. But last year, it was very much true. Last year, if you sold in May and you bought, if you sold in May, was the best time to sell and then buy back right before school starts in September. So I think that, whether that happens this year or not, in large part hinges on what the Federal Reserve says or does this Wednesday, because stocks are trading near 1-year highs. And the market is based upon, CME Fed tool. For those of you that know how to track it, the CME Fed tool shows about an 85% chance of a quarter point hike this week. And it's actually showing an interest rate cut by the Federal Reserve in September. So, I think, that's going to be interesting. And, if the Federal Reserve, kind of reinforces that and suggests that, we're kind of done, then we'll probably continue to see the rally in stocks. But if they suggest that, I think, we're going to take a break, this could be the peak in the tightening cycle, then, if they suggest that more is to come, then that could be really disastrous for stocks. And, right before we came on live, we were all talking about the ISM prices number and how the price component of the ISM manufacturing index surged, really big increase. I'm looking at the numbers right now. And
52. It's 52 against like a 47 odd, which is like a 5-point number. That's a big, big jump. And definitely not the thesis of everything is coming back down because supply chains are back in order, production is back in order. Like, that's a shocking number on manufacturing.
This is the strongest ISM prices number we've seen since August of last year. So, 9 or 10 months, it's a really big. Did you change the numbers?
Sorry.
And guys, if you would just tell us what that means in layman's terms. That means inflation is going to be stickier for longer?
It means that
what's the implications of that?
it means that inflation is stickier.
Implications of that?
It means that inflation is stickier for longer because everyone's talking about falling inflation. Everyone's pointing to prices, commodity prices declining, but the number that the ISM is giving us is telling us that it is not falling. It is rising, and it's rising at its fastest pace since August of last year. So the Fed may not be able to slow down, and if they indicate that they're not able to slow down, that that they're still thinking about more rate hikes, which is not what the market is priced in right now. I think you're going to get that sell-off in stocks. I think that's going to create a catalyst for the sell in May, go away historical trend that we tend to see in the markets.
And just for clarity for some of our viewers as well, I know we talked about the rate hike isn't as important as the guidance they're going to give, what they say. What kind of words, what kind of phrases are we looking for that's going to indicate longer for higher from the Fed? What are we looking for direction from them?
I think it's going to be the tone. It's very much going to be tonality. They're not going to. They never play their hand completely open. But if Chair Powell doesn't sort of say, yes, we think we're close. If he doesn't use the words, we think we're close to terminal rate. If he says, we're very data dependent, I think the word data dependent is going to be very negative for the market. Because what that means is they're still watching the data. They don't think the data has peaked out, and it's hard. This is a horrible number to print ahead of FOMC, in my opinion, especially for somebody who sort of thought that inflation was really, really under control. I don't know if it's a one-off. I don't know. I don't know where the flow through happened here, because we have to kind of deconstruct this a little bit deeper when we look at it. But on face value, that's a horrible number for everybody whose thesis is inflation is dead. Inflation is certainly stickier and is definitely tougher to combat than just simply if we fix the supply chains and get it all done. So yeah, the Fed may have to stay the course. I don't think he wants to communicate that he's going to keep raising rates, because we already see with First Republic as our first victims of a credit crunch that it's going to get harder, and you certainly don't want to suffocate credit to the rest of the economy. You don't want to kill the patient by curing. You don't want to cure the patient by killing him. So I think he's very mindful of that, especially into the election year. Like that would be the worst political function of the Fed. They're very cognizant of that, and they really don't want to tilt the election one way or the other by basically tanking the economy into a recession. At the same time, I think he's very, very mindful of the fact that he needs to keep the inflation under control, and his only tools is monetary policy. So we'll see. It's easy to kind of get very, very overworked about this. It's just one print. We've had most of the prints have all been going down, but this one print is definitely an aberration that we should all be mindful for.
Something to watch. Thank you.
Right. We also have ISM Services that is coming out, and that is also a very, very important report. I think. What does that come out for us? I'm looking at the calendar right now.
It was Wednesday.
It comes out the morning of the FOMC rate decision on Wednesday. So, there's going to be after this number that we had today, the ISM manufacturing number, investors are you're seeing a little bit of reset in expectations. And I think that, because the market is still left guessing, I think when we get the ISM number on Wednesday, services, because the U.S. is a service-based economy, that's the most important. And, where prices are in the service sector, if that is equally hot, then I think, you're going to see, not only the U.S. dollar, extend its gains going into the Fed meeting, but you're probably going to see, stocks pull back as well.
Right. Because that is an indicator that we are stickier for longer, both services and manufacturing.
Yeah,
both sides.
Sure. Absolutely. And, like Boris said, the Fed is probably not going to be completely clear cut. They're not going to lay out their next 6 to 8 month plan for us. They're going to, kind of be a little bit elusive. And if they are, that will make this Friday's non-farm payrolls report very market moving. Because if they keep the market guessing, the only way that the market can, wrap their heads around what the central bank will do is based upon data. And, because, that's probably what the Fed's going to say. Everything's going to be data dependent. So it'll be much more sensitive to data. And we love that because, we love trading news. We love trading data. And for, anyone who's, into short-term trading, sometimes, the news releases can be boring after a rate decision because we already know what the central bank plans to do. But I think this time around, it's going to be different. I think this time around, NFPs could be very market moving. And the market is looking for a pretty weak NFP number, which would not be consistent with what we've seen so far in the ISM prices data. So basically, a lot of confusing data, and confusion, I think, equals volatility, which equals opportunity for us as traders.
Right. I know we've been at a historical low volatility. So this week we're looking for a spike up depending on what the Fed says and non-farm payroll. How high do you think we can get?
In terms of the dollar?
Volatility.
In terms of volatility? Well, I think that we'll probably definitely see an increase in volatility, but I think it really depends. I mean, honestly,
we could have a 2% day. I don't think that's out of the question. We could have an easy 2% day on Wednesday with depending what the Fed says, especially if the Fed if he just really sounds hawkish, that will tank equities really hard, in my opinion. I'm looking at more details on this pricing thing, and it looks like steel, copper, plastics, diesel was what's putting the upward pressure, but it was mostly kind of divided. 9 industries reported increased in raw materials, 7 reported paying decrease for raw materials. So it's not like the inflation is dead. It's still fighting, but it is definitely losing some of its punch. Again, I think a lot of it is going to be how tough he sounds on Wednesday. That's going to really have an impact on the market. One thing that we've been talking about over the last couple of weeks is this divergence between NAS and Dow recently, right? I mean, NAS has had a huge run. We're up 15% on year end on the assumption that money will stop being expensive, because for NASDAQ, it's all about money, the cost of money. But last week, we've seen this divergence where the US 30, the Dow and the S&P have been rising, the NASDAQ has been falling, the NASDAQ's been weaker. And I think that's being expressed, this whole, risk off things is being expressed on the fears that, this is not going to be the terminal rate. There may be another couple of hikes left. If that's the case, I think it's going to hurt NASDAQ. A lot of that rally, 15% up, might unwind into the next quarter.
So I think the interesting question and the important question to ask is, how do you trade these big events, right? Because, we're all traders. We're talking to traders. Our listeners are traders right now. And so they want to know, you got a huge event week. Should I stay out of it? Should I trade ahead of it? Should I, trade after it? And what we typically recommend with these big events, especially given the kind of coin toss it is to trade reactively. And that's generally what we do when we news trade anyway. So particularly with, RBA, I don't think Reserve Bank of Australia, the first rate decision that we get tonight, I don't think that's really going to be that market moving. No changes are expected. Everyone expects no change. But FOMC, it's going to be a big one. So the FOMC is a 2-pronged decision. You've got the rate decision at 2:00, and then you've got the press conference afterwards. So typically, you have an opportunity to trade right after the rate decision. I don't think that they're going to be on hold. I mean, if suddenly they decide to be on hold, that's a really big tradable opportunity. If they decide to raise more, that's going to be a big trading opportunity. They're probably just going to do 25. If they just do 25, you're not really going to see much movement. But then when the press conference is given, that's where the guidance is. And in the first 15 minutes after the Fed chair speaks, usually you get, whatever is planned to be said is said. And then you get the initial questions from reporters. And all of the important questions are generally asked in the first 3 questions. So once that is done, whatever move that starts to transpire is the tradable move. So to put this in more precise terms, I would say,
Kathy, before you go on, when you said the first 3 questions.
Yeah. The first 3 questions.
What are we looking for as far as questions?
Well, I mean,
typically, what are they?
I mean, typically the first question is probably somewhere around, do you plan, is this the end of hikes? Is this,
very
where's
direct.
Trump?
I like that.
Yeah, I mean, but of course the Fed chair's job is to dance around that question, right? I mean, I don't know if you want to share your thoughts on this, Boris, but first question is definitely going to be, about the, and then about what they plan to do going forward. They're probably going to ask the question about the banking sector. And whether or not they think there's going to be more trouble in the banking sector,
Yes.
conditions, and they're probably going to ask a question about inflation. I don't know if you think I'm missing anything, Boris.
No, the question, what the question is going to be? How can you keep raising rates while banks are failing? Aren't you going to put the economy into recession? And then the second question is going to be, how can you not keep raising rates when inflation is rising? Aren't you going to create inflation? They always put them into an impossible position, and then he kind of tap dances around it. So yeah, I mean, that's going to be the tone of the questions, I think, coming out of it.
I mean, they're basically going to try to get one answer in multiple different ways,
right.
Which is, is there going to be another rate hike at the next meeting, or are you done? And that's the only answer that these reporters and investors are going to be listening for.
And my suspicion, and as we're talking now, NASDAQ making session lows, finally, responding fundamentally to the news. My suspicion is he will categorically not signal any type of a pause. Oh, sorry, guys. Oh, New York. Oh, geez. Welcome to springtime. Sorry, once again.
Bless you.
Anyways, I think he will categorically stay at best neutral, and very likely say no. We don't feel that the battle against inflation is over. We reserve the right. We're obviously always very, very data dependent, but we don't see. He's going to say, look, we don't see labor collapsing. The economy can absorb further rate hikes, and we clearly see some price pressures. I think he's going to be more hawkish than people let on, and that might be a shock for the market.
Yeah. And the same goes for ECB the next day. The European Central Bank monetary policy announcement, also, two prongs. You've got the announcement that, probably 25 basis points, but there's a small but realistic chance of 50 basis point hike. If they do 25, it'll probably be a little bit of a disappointment. Obviously, if they do 50, it'll be a big upside surprise for the euro. And then comes the presser. And if they do less, then it's probably going to be accompanied by some hawkish comments, which will be positive for the currency. And that's where the real trading opportunity is, which is basically about 15 to 20 minutes after the press conference. Whatever direction the market starts moving in is probably the direction that's going to carry over for the rest of the day. Now, on Friday, non-farm payrolls is much easier trade. 8:30, that's it, right? We don't have to wait. We don't have to guess. We don't have to interpret the what is being said. 8:30, the number's out. Typically, what we like to do is we like to wait between 5 to 15 minutes and to let the market digest the data and figure out its assessment, and then ride that move that comes out afterwards. And actually, I've got a couple of YouTube videos on how to trade news that cover, the strategies that you could use to trade non-farm payrolls, as well as, FOMC and ECB.
Excellent. And Kathy, are you going to be trading it with the ZIP indicator, or how are you going to be trading this?
No, we have news trading with specific news trading strategies. ZIP is a indicator or strategy based upon 1 hour charts, which I will be using. Like we talked about this before, where with the ZIP, if we have an event risk coming out of the US session, I'll wait for the Asia session to trade it. So that's like a full, almost, half a cycle. If the ZIP holds, then I'll buy it. But usually with the event itself, we're trading our new strategies. And Boris has some really great strategies for trading it.
We do. If you want, if you don't mind, I can share my screen for a second.
Yeah, please.
We traded dollar yen this morning. That was an easy trade. Let me just share.
And for those of you who are on Twitter Spaces, we have the YouTube link that we posted that you can use to look at Boris's charts. And if you got questions, feel free to ask it on YouTube or post it over Twitter Spaces.
Yeah, I'm going to make my screen big because Kay is always yelling at me that my screen. I have a huge screen, and of course, everything looks microscopic when you show it. So this is my bounce indicator. It's super simple to explain how to make money in the market, especially when you're trading news. The red line is the session low. The thin black line is the midpoint. The green line is the session high. They're all dynamic. So in other words, the higher it goes, that green line is going to go higher. The midpoint is going to adjust. The lower it goes, the red line is going to go lower. The midpoint is going to adjust, right? That's it. It's the field of play. If you're above the midpoint, you're attacking. If you're below the midpoint, you're defending. Attacking means you're in uptrend. Defending means you're in a downtrend, okay? If you're trading dollar yen, if you're above the midpoint, you're long dollars. If you're below the midpoint, you're short dollars. You're long yen. So news comes out at 10 o'clock. I'm going to mark the news. We obviously have a little bit of a gap because that's totally normal on the news. And again, this is why we do never trade the news, never anticipate the news. We don't guess. We try to assess. So gap happens, blah, blah, blah. Markets absorb. Our strategy is ridiculously simple. And in this case, it was super easy. The strategy is the following. News comes out. We don't judge the news. We judge the reaction to the news, right? So in other words, I know this was uber dollar bullish, but if the market was tanking, I would have been selling it. But it was uber dollar bullish and the market was rising. It was confirming the fundamental factors. So our strategy is very, very simple. We basically just, if the market is above the midpoint and there's a big, big green candle, post-news, we're buyers. That's all it is. There's nothing complex about it. Now, I'm a scalper, so we just scalp. So we were long here at around 96, 97, 90, let's say 97 with the spread. Yeah, it was 97 actually. We're long 97. It's a very simple trade, 10 up, 10 down. We're risking 10 to make 10 because we're scalping the natural momentum post-news. It took 4 minutes. 1, 2, 3, we actually maybe 5 minutes, took a little bit of a while and went to also what was super easy about this trade is we were right underneath the round number. And Kathy will tell you that in FX, if you can break the round number, you do break the round number. It's like it's incredibly potent magnetic aspect because so many people leave their stops right around the round number, right above the round number. So it's super easy for dealers to want to gun the stops. Take out the round number and then, see what happens. In this case, seeing what happens is there's more fundamental flow after that. There's more real money flow coming in after that. But whether, to us, it's immaterial. We got our job done in 5 minutes flat and we're gone. That's it. That's my new scalp. We love to use it. It works like a charm across almost every big event that we can find because it's very concentrated, very focused, and most importantly, very rules based. There's no disagreement as to how it's done. There's no interpretation here. So that's it. That's what we did this morning for the dollar yen.
Excellent.
So I did not trade ISM, but last night I put on, let me see if I can share my chart, a dollar yen long trade as well. Give me a second to share my screen and explain my trade. So I put on a dollar yen long trade as well. And, there wasn't any pure zip signals here, but the background was green. So in my zip chart, when the background is green, it basically reflects the longer term trend. And when the currency pair is trading above the indicator line, it reflects the shorter term trend. So dollar yen, at the Asia Open, which is when I traded, which was right over here around 138.60s, was in the buy zone. And it was trading in the buy zone. And so, I had a strong view that, that we would see, the yen remain depressed after the BOJ rate decision. Stocks did really well. Stock futures were kind of up. So I went long, and dollar yen looked like it was bid. So I went long dollar yen and really did nothing until the data. And pretty much on the data, it hit my profit target. So we didn't hold the trade. We didn't take any new trades after the data, but we held the trade into the data and it ended up hitting our profit targets. Now, today is honestly a very volatile day. I was watching gold this morning and gold has just triggered a zip sell signal. We'll have to see whether or not that lasts. But you can see this topsy-turvy movement in the markets because, we had crossed this above the indicator line, but there was no continuation, and once the data hit, it kind of got killed. Now, if you were selling zip, if you were trading zip after the data, you could have caught perhaps this short move over here in EURUSD. But it was a very choppy day because of the May Day holidays, and in general, holiday trading is a bit of a challenge. But I think all of it will kind of sort itself out, and we'll get some, clear direction. But now that we are in the sell zone for Eurodollar, and we're in the sell zone for gold, I think that, the market's definitely leaning. You see that in U.S. yields. U.S. yields are up 3%. I think the market is definitely leaning towards positive dollars, and they're probably going to remain leaning towards positive dollars going into tomorrow's numbers. And so, that's something, that is definitely worth considering.
So, Kate talking about gold. I think gold is to me, it's one of the most interesting trades in the markets right now, because it's broken so many hearts at the 2000 level, right? So many people are just looking, itching for it to move higher. However, as Kay is saying, if the Fed stays hawkish, there's a huge competition. If you get 5% out of cash, why would you want to hold gold and pay carry against that? It's very, very unattractive. So I think it'll be very interesting to see if Powell is hawkish, gold could drop through the 1900 level, like take out the 1900 stops, which will be interesting. Now, what's more interesting to me is if that doesn't happen, like that would be a natural move. Naturally, Powell's hawkish. We're not gonna stop at 5. We're gonna go maybe another 50 in a cycle through the end of the year. That gold should go to 1900. If it doesn't, if it kind of holds bid and then rallies back up to 2000, that is going to be an uber bullish gold signal, in my opinion. Like if gold can withstand higher yields and price just sort of stays there, that means there's a long-term bid there that people think, okay, we have structural inflation. It's going to be, decades or half a decade of this stuff, and gold goes to 25, 3,000 on that move. That's not my base scenario. I'm just sort of playing out. This is how I would read the market, depending on what it does and how I would read, given just our experience with how things trade.
Now, Boris, let me ask you this: as a scalper by nature, how would you take advantage of that trade? Or would you?
Well, as a scalper, I would just simply trade the news reaction. But as a positional trader, somebody who something that I used to do. Or just something that I've seen many times. Just because I don't do those trades doesn't mean I don't see those trades. I've seen those trades 1,000 times, and people who have more patience than I can benefit tremendously from that. I mean, the classic trade in the market is when news does one thing and price does another. And typically the amateur response is, no, news is right. I need to change, I need to fade the price. When the correct response is, no, there's something there that you don't understand. You need to trust the price and fade the news. Generally, that's always much more profitable path than trying to shove your fundamental view into the price. But generally, the best situation is when your fundamental view and the price converge. Then you have this perfect confluence of flow, just like we did with dollar yen, and it really works nicely. It's both psychologically and financially very lucrative when you're in sync with the market.
And if you look at, ultimately, if you look at this chart, gold has been in a very, very narrow range for the past 2 weeks, and it's itching for a breakout. And there's no better catalyst for breakouts than central bank rate decisions. And so when it breaks out, it's going to move. And when it moves, that move is going to last. So there's no need really to just kind of sit here and guess. Let's wait for the big event to occur. Let's see what the move is when it transpires, and then let's ride the move when in the days and weeks that follow. Because I think the market is waiting for the clarity that we'll probably get from the central bank this week.
Yeah, I think like another thing that people don't quite appreciate is the market is just a reaction machine. It doesn't have an opinion, doesn't have a memory. It's a reaction machine, and what it reacts to is news flow. News flow and price flow. So until you got one or the other, you got nothing, which is what we have today. We're just we're twiddling our thumbs. But when we do have big news bombs or big price moves, that's where the opportunities lie, because that reaction machine usually has a much longer than just a 1 day cycle. Maybe it's a 3 or 4 day cycle, and there's like lots of opportunity there, right?
Absolutely.
Right. Hey guys, for anybody just tuning in or is not familiar with the show before, anybody who's with Surge taking an audition gets a 30-day free trial. to BK Trading, BK Forex. All the indicators we're going over. You get all the mentorship for Boris and Kathy. Just as long as you're in Audition, it's all included for you. So definitely take advantage of it. You can find it on our website. All of your welcome emails, the BK Trading website as well. So definitely take advantage of that. It's very valuable resources.
Thank you.
And and Boris, throughout the course of this week, will be live trading every single day. Sometimes it'll be around the event, sometimes it'll be after, but there's definitely opportunity, even though we've got so many big events ahead of us.
Yeah, absolutely. Very gonna be as a matter of fact, probably from Tuesday to Friday, there's gonna be lots and lots of trades. Today was sort of, as we said, we pulled away because it's a holiday and everybody's just sitting on their hands waiting to see what happens next. But there will be a lot of fireworks as we go forward. Yeah.
Excellent. So in ordered from most important to least important, would you guys give us the news of the week?
Oh, I think it's definitely gonna be FOMC, ECB, and then NFP. We have a question on YouTube about, and I think it's a very good question. Where do we find the analysis from central bankers on whether it's hawkish or dovish? Because you and I can talk about it, but many people who are listening may not understand what language is used, and whether that is hawkish or dovish. And the best place to get the instant interpretation of the event is really off of Twitter. And you can also turn on CNBC or Bloomberg.
I'll go one further. I would go to Forex Live, because those guys sort of specialize in covering the Forex market. They are the first ones. They'll do the snapshot of like the difference. You know how like we see all those, FOMC last time what they said, FC what they said this time. There's like a little bit of a what words changed and stuff like that. They'll post those pictures on there, and they generally will synthesize what everybody else is saying, and that's a good first place to start, in my opinion. That's where I would go. But yeah, Twitter is absolutely as the platform, and within Twitter, I would certainly put Forex Live as my number one, my first go-to as for post analysis plays.
Yeah, and it's all free. It's all you have to do is we suggest you use TweetDeck, set up your TweetDeck, and add those feeds on, and you'll get their interpretation, because it is hard. You have no idea what you're looking for, and it's much better to get the experts to look to interpret it for you. I also like Investing.com as a news feed, and I'll share we shared this on Friday, but I think because people are still asking and because it's such an important week. Let me see. Do you see my TweetDeck? No, let me.
Not yet.
There we go.
There it is.
So I've got Forex Live here, News Squawk, Investing.com. These are probably the top 3 I would recommend for news feeds to follow for instant news releases. And then
we'll forgive her for the zero hedge column that she has on the side. No, I'm just kidding. No, zero hedges is actually very good as far as news reaction. If you ignore the end of the world, right wing polemics, it's very good as just a news dissemination website.
But sometimes they have really good, like here, ISM Scream Stagflation. Usually it's kind of a feed from other people that they're pulling information from, and so they got really good dissection of some of the big events, which I like quite a bit. Like you see all these charts, they dissected and kind of explain to you what you need to know about the ISM report. So I like that.
As long as you invest the exact opposite of what they say, you'll be fine. But when you read them, that's fine. But what Kay's done, by the way, just sort of from a mechanical point of view, this is a very, very clean layout. So she has one Twitter account per column, and that's so that limits your ability to follow people. But the upside of that is that you have totally clean data in front of you. You really, you're not polluted by everybody else's voices in that column as you go through.
But it doesn't limit my ability to follow people, because on the left side is my aggregate feed.
Right.
And includes everything. Like here, sentiment trader, money market funds surge 33%, blah blah blah. You get lots of miscellaneous information that you can put here in case, not all feeds update as often. And so it's like I have Wall Street Journal, the Wall Street Journal markets.
So what I was going to say is the advantage of doing it the way she does it is that you will not miss the important information for all the clutter, which sometimes happens on my feed because I have my feed is much more cluttered than hers. What I mean by that is that because you have one user defined column, everything that user, and in this case Forex Live, these are news feeds effectively. These are like Bloomberg synthesis, is really right at your fingertips, and then you could go straight to it and see it.
Guys, I know we've brought this up several times before. How important is this for you as far as knowing what the markets are doing? Should everybody be doing this?
Yeah, absolutely. I mean, I think that it's absolutely important to have your pulse on the market and know, why in the world did the dollar skyrocket? You won't know unless you've got your at least one eye on the news feed. So I have multiple monitors. Some people trade off their mobile or on their laptop, but even on laptops you can split your screen. So whenever we have news releases, I'm always watching. And even when I start my day, I'm always watching to see what the news reports are.
Got it. So easy to set up, totally free. All traders should be doing this. Really keep your finger on the pulse.
Even if you're just trading purely technical positions, which is primarily what I do, it's very, very important to know context. Technicals are useless unless you know the context. Kathy will be the first one to say that she's a queen of marrying the technicals and fundamentals together. So it's really important to understand, is price cooperating with the thesis? It's not. And if it's not, you need to understand, where the potential pitfalls are. It is, trust me, it's not the Fibonacci retrace. It's not the support resistance line. It's not the little wiggle on your chart that's going to make you the money. If it was, it's because you got lucky. And trust me, you cannot replicate that over and over again. Because if you could, I could create ChatGPT code in 5 seconds and be able to mimic what you're doing. There's an element of art here that requires knowledge of the markets, and that element of art really needs to be learned.
So there's another question. Is it normal to see stock futures, 10-year bonds, and dollar all bullish after ISM? Well, I mean, that can oftentimes happen when the market is completely confused as to its implications, right? Usually you do see, I mean, today's, the prices component was very hot, so indicating that inflation is much harder than people anticipated. So it makes sense that treasury yields are up significantly. It makes sense that the dollar is up significantly. Now, it does not quite make as much sense for why stocks are up, but stocks are really not up that much, right? And they kind of are attempting to peak. If you look at the 1 hour chart of the Dow, there's a bit of a doji candle there. It looks like it's attempting to peak. So I think there is still some consistency in the markets, but the bulls in the stock market don't want to give up yet. And they need a little bit more stronger evidence. Their conviction is wavering, as we see in the 1 hour charts, but I don't think they're ready to give up yet.
And first of all, NAS is at session, 10 points off session lows. So there's when you're talking about stocks are up, you're talking about the more industrial stocks like, the Dow and the S&P, but technology is dying because technology really doesn't like high rates. And it's clear.
So we have another question. Can you please explain the audition? If I apply, will I be mentored by BK? Do you want to explain the audition quickly, Corey?
Yeah, of course, absolutely. So when you come to Surge, essentially what we do is we put you in an audition account, which is a demo where you go into the markets and you trade as you normally would. And then part of the program is we give you access, or BK provides you with access to their training. And that's going to be some mentorship. It's going to be the indicators. It's going to be all of their archived educational materials where you could go in there, dig through, find what works for you, get a program together so that when you go through the audition with us, you're successful. Once you pass that audition, now you're in the live trading. And that's where it's very important to also make sure you're up on your education, make sure you're up on your knowledge, to continue and keep that account active. So it's kind of two different things, but you will get some education, some significant education and mentoring from BK.
Yes, absolutely. We have another question, but I think I'm kind of confused what they're asking. Whenever sentiment changes, good news also turns bad. Can you explain how sentiment analysis works? I'll just explain the latter part. I mean, sentiment analysis is basically, what is the market expecting? What is the general mood in the markets? And that is extraordinarily important because, the Fed is expected to raise 25, but that matters far less than what the market, whether the market thinks that's enough or not enough. So the question is, how do you get that information? You get that information on these same, Twitter handles that, are published here. You read, probably the dominant article on Wall Street Journal or CNBC about what the big news is happening. That will tell you what the market is anticipating, what traders are positioning. And sometimes when the data is completely opposite of what the market expects, that's when you have sentiment shift, and that's when you have a big movement in the markets. So we are also being asked, do you expect euro dollar to be, do you expect to be long euros and short dollars this year? Do you expect the euro to outperform, the US dollar to underperform? Obviously a lot can happen between now and the end of the year, but I think that the European Central Bank has been very clear on their plan to raise interest rates and continue to raise interest rates. The Fed is going to stop sooner than the ECB, and it's just a matter of whether it happens this month or next month. And I think usually what ends up happening, especially in this cycle, is that the U.S. Data and U.S. economy is going to lead everyone else. So it starts sucking first. That's going to lead to U.S. dollar weakness, and then you will start to look for weakness elsewhere. So in a nutshell, yes, I do think that euro is going to remain strong into year end. But good questions. Yeah. Wow, they just keep coming in, Corey.
We're getting some traction here with the show, guys.
How much fundamental analysis in the market is important for us? Or without fundamental analysis, can I make money just from the charts? Why don't you take this for us?
No, you can't make money from just from the charts. And everybody who tells you they make money just from the charts is fibbing. I'll be very polite instead of what I really want to say. Yeah, you could make money just from the charts because you're lucky. In other words, you could do it for a month, you could do it for 2 months, you could do it for for 3 or 4 weeks. You will eventually let that luck run out because the charts are reflecting the past and they are inputs of everybody's sentiment and ideas about where things are going. And they're not going because the Fibonacci level hit it. And it's not going because it's the Elliott fourth wave. I mean, my favorite joke in the world is what's the most Corey, what's the most popular tool of Elliott wave technicians?
What is it?
The eraser. Okay. So the point being is I am essentially a technical trader. I trade primarily charts. I trade primarily price action. But I would never think of not paying attention to fundamentals or understanding what are the dynamics, for the markets. Now, the reason, by the way, why my style works on a technical basis is because I'm literally trading the 1 minute chart. I am basically doing high frequency trading, which is the closest non-market material way of trading it. But even the HFT firms like Citadel and Virtu, all of them are highly aware of what's going on every single day because they know how much volatility that day is going to bring. They're not just simply, making markets the same way on Monday as they'll be making markets on Wednesday. The point is, markets are made up by human beings. Human beings react to news. It's not charts. It's not a little wiggle on the chart. That's basically the reflection of human behavior. And you cannot trade what happened yesterday on human behavior and assume that's going to happen tomorrow. You have to know what's happening today to have a much better idea what's happening tomorrow. So my point is you do have to know fundamentals. It's not hard. It's actually, it's the most actually interesting part of trading because it's news. It's like, if you like current events, this is the only place in the world where you can make money out of current events. So it's a lot of fun, and you don't have to make it, you don't have to drone on endlessly and watch Bloomberg for 10 hours to absorb it. Literally, it's 3 sentences. Like everything else is just footnotes. But you do need to know those 3 sentences every day to understand how things are trading.
Okay. Boris, do you expect the S&P to correct this year? If so, when? Q2 or Q3?
I have no idea. I wrote my column yesterday was called "Forecasting is Folly." I'll tell you the lesson I learned a long time ago. I went long time ago, like literally in the early 2000s. I was visiting a quant fund in Midtown Manhattan. These guys had more computers than the Pentagon did, and they were very, very smart guys, all PhDs. They'd done huge amount of currency data analysis, and what they discovered is that within 24 hours of any input, fundamental, technical, or price based, the forecasting value of that input degraded by 50%. And by 72 hours, it degraded to zero. In other words, you could not make any kind of intelligent forecast 72 hours forward. So I don't know. I mean, there's a million things that could happen between now and then that could be either super positive or super negative to the market. Generally, over the long run, you always want to buy the dip. It's the market is an upward trending place. And if you're an investor, you just want to buy every dip possible and dollar average into a position. It's very boring, but it's literally the single most profitable strategy you could possibly have. If you're positionally trading, I love listening to all my friends on Twitter who are macro traders, positionally, try to forecast the next week, the next 10 weeks, and then 15 weeks, and inevitably they're all wrong, and inevitably they're all trying to justify how wrong they are, and they just like, no, it's just a matter of time. Oh, no, I'm still doing this. Occasionally they throw in the towel, and I find the whole process amusing because it's as good as basically having a monkey throw a dart against the wall. It's very hard. What you want to know is you just want to know what the key issues are, and when those issues have a big tangible shift. Excuse me. Sorry. Oh God. I'm sorry, guys. The allergies are killing me today. So the point being is, I have no idea. Who could have told you that everybody thought Nasdaq was going to be in the toilet Q1? We're up 15%. Could you have forecasted that? Almost nobody did, right? Does Bitcoin go to 100,000? I'd be shocked, but it's possible. So I try not to forecast. I try to just basically observe because that's your best path towards profitability.
So here's a really good question. Do we take seasonality into consideration in our trading? I think seasonality is an important thing to understand and recognize. But at the end of the day, we rarely see a seasonal pattern that, holds up for a long period of time we just rarely see it hold up for a long period of time. And so, while it's interesting and we do keep it in the back of our minds, it doesn't really directly affect our trading because trading is dynamic. There are obviously certain periods like August that tend to be quieter and thinner. And we take seasonality's impact on liquidity into consideration, but less on price patterns.
You want to know my favorite seasonality story? You want to hear my favorite seasonality story? So
yeah.
Here's my favorite seasonality story is orange juice. So for many, many, many years, orange juice was basically buy the summer, sell the winter. Because in winter, Florida produced all the orange juice. There was tons of supply. So boom, 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 oranges, were plentiful. In the summertime, they were very scarce. So you bought orange juice in the summer, you sold it in the winter, right? That was the seasonal pattern. Then Brazil came on board. Brazil is on the other side of the, is in the southern hemisphere. Flip seasons. They are a massive country with lots and lots of production. They started to swamp the summer, the summer season with oranges. So the pattern completely flipped around, where it was basically buy the winter, sell the buy the winter, sell the summer. So there's my attitude about seasonality. It's good until it stops working, and then it stops working.
So many of you seem to be really enjoying this, and they're asking us, will we be doing more of these? Want to chime in, Corey?
Yeah, absolutely. So we visit every Monday and Friday at 11 Eastern for 45 minutes to an hour, and you guys can catch us here every week, twice a week.
Yeah, I would subscribe to the Surge YouTube channel, and
you get updates, notifications.
Yeah, exactly. And I'm glad you're enjoying it.
And go try their audition. It's a lot of fun.
Yep, absolutely.
And you learn about the market at a much, much lower cost than burning your own money. And it will be more fun, and it may even be much more profitable in the end if you can pass those auditions.
Right. Of course.
Exactly.
All right, guys. Well, thank you again so much. It's a pleasure. I know we've got an exciting week ahead, so good luck with your trading, and looking forward to Friday where we catch up and kind of digest all the information together.
Yes, that'll be a lot of fun. We'll see
All
you
right,
then.
sounds good. Good luck, everyone.
Thanks, guys.
Bye, guys.